Hello everyone, welcome to episode 2 of the Akambo investment series for 2014. My name's Anthony Kapitanovich, I'm the Managing Director of Akambo Private Wealth, and once again I'm joined by our Head of Investments, Chris Wilton. Chris, we're now 3 months into 2014. Expectations were very high, coming off a really strong year last year in world share markets. It's quarter time, how are we travelling?
Well, by and large, share markets around the world are pretty flat on where they finished 2013. The Australian share market's almost exactly the same level, as is the US share market. There's a couple of notable exceptions there. The Japanese share market's down 10%, although they were up 56% last year, so it's no great tragedy there. The Russian share market is also down more than 10%, and that's no surprise given the volatility and turmoil we've seen come out of I guess the conflict between Russia and the West over Ukraine and Crimea of late. The Chinese share market is down a little bit. There has been more weak economic data out of China, which has, I suppose, got some investors a little bit more nervous. But we've generally seen a trend towards optimism about 2014, but the key flashpoints that we saw at the end of last year, which were the fear over emerging markets with the US government withdrawing stimulus and also the slowing of the Chinese economy, they've been the two prominent themes in the first 3 months of this year. More recently, we've seen a lot of concern over what's happening in the Ukraine. That seems to have abated a bit over recent days, but there's still a prospect that that could flare up in the coming weeks and months.
Many economists have been expecting a subdued performance of the Australian economy, notwithstanding that the Australian share market still has a positive outlook. Do you think that's still a consensus view?
Well, the interesting thing about the Australian economy from the last couple of months of data is that views have generally tended to move to a more positive outlook for the Australian economy for the next 12 months. Coming into the start of the year, there were some fears around the slowing of the resources sector and the impact that would have on the broader Australian economy. It seems, though, that housing construction is really starting to pick up the slack. The housing construction could potentially be a huge employer for the Australian economy. We're seeing an enormous approval in apartment dwellings in Melbourne and Sydney in particular. Unemployment rate is sitting at 6% at the moment. At the start of the year, some expectations were looking for perhaps 6.5%. Some of those have been reined in, and we might see 6.2% on the unemployment rate in Australia. We've seen a lot of job layoffs or proposed job layoffs in the last few months from some big corporates. That will flow through in the next few months, and we will see the unemployment rate tick up a bit, but it might not be the doomsday scenario that some economists were predicting. And on that as well, we've seen the Reserve Bank indicate that 2.5%, which is where the cash rate is at the moment, might well be the bottom of the range. Some economists who are more pessimistic about the outlook for the Australian economy had been calling for perhaps 2% on interest rates. It seems as though 2.5% is the consensus for the next 12 months, and there's even a chance that in 12 months from now we might start to see that pick up. One notable feature about the perceived strength of the Australian economy is the recent results from companies through reporting season that we heard in February, and by and large they surprised on the upside. There were certainly some disappointing performers, but the general view was that the results were better than expected, and that's generally held up the share market at reasonable levels that are at 6-year highs for the Australian share market.
Now, in January we spoke about the importance of the Chinese economy and the impact that's likely to have on our market and the Australian economy. I note that in the first few months of this year we've seen continued slowing. What's that telling you, and what impact's that likely to have going forward?
The first point to make there is that the first couple of months of the year in China, the data is going to be skewed a little bit from month to month by the China Lunar New Year. And that's been, I guess, blamed for some of the weak data we've seen out of China, but really we've seen that it's really just a continuation of the trend we saw through the second half of last year, or through the last few months of last year. And I'd say to a large degree it's a government-engineered slowdown. The government in China is cracking down on excess credit. There's a fear that a lot of this borrowed money is going into unproductive fixed asset investment. A lot of unproductive property investment, infrastructure investment. So that's still a big concern in China, and I think the government's going to keep its foot reasonably closely on the throat of the credit limits in China. What we've also seen over the last a few weeks in China, or a couple of months really, is fears for the stability of the banking system because of this excess credit. And in fact, we saw just very recently a bank in China, there were fears that it might be insolvent, and there was a big queues of depositors lined up outside to withdraw their money. So that's a fear that could become more rampant in China. A lot of the rumours in the past week out of China have pointed to more stimulus from the government. We saw this around the same time last year, where economic activity started to slow. The government stepped in and announced a large expenditure on a lot of infrastructure projects. There's a chance it might happen again, but I'd be wary of relying too much on the Chinese government to open the purse strings to spend a lot of money when they're quite wary of the fact that there's a lot of unproductive fixed asset spending and investment over the last couple of years in China. The Chinese government's recently stated that they expect growth in their economy of 7.5%, or about 7.5% for the coming year. That's a figure that's still very strong in the world's second largest economy, and I think that that's a figure that should satisfy, if it's indeed delivered on, that should satisfy a lot of doubters about the prospects for the Chinese economy, and that should be a sufficient rate of growth to help global growth continue to be supported over the next 12 months.
Now, Chris, I know you're probably not that keen on me holding you to task about things that you said in episode 1, but one thing that did ring in my ears from episode 1 was how many times you mentioned that the US government and its tapering of its stimulus, the impact that would have on world markets would be quite significant. How's that playing out?
Look, we did say at the start of the year that the government stimulus, the central bank stimulus, was overwhelmingly the biggest driver behind share market growth last year. The US government did start to withdraw some of that stimulus, or take the foot off the pedal with that stimulus in December. The $85 billion a month that the central bank was pumping into the US economy has now been tapered down to $55 billion per month. So it's still a lot of money, and if you say it really fast, it doesn't sound like a big number. But $55 billion a month is still a lot of money to prime the US economy. What we've seen over the first few months of the year in the US is some indicators pointing to a slowing in the US economy. That's by and large been blamed on some bad weather, some extreme bad weather that we've seen in the US. Over the next month or so, time will tell whether it has been the weather or it has been partially an impact from the withdrawal of that stimulus. But by and large, the US data has been sufficient to indicate that the economy is on track for a reasonable rate of growth. Unemployment's coming down in the US. We have a new central bank governor in the US, and it's a governor who is generally seen as more relaxed about keeping interest rates lower for longer, although that thought bubble was pricked a little bit by the fact that she did indicate only very recently that she might indicate the interest rates might increase as early as this time next year. That did spook the markets temporarily, but by and large, it's expected that stimulus will continue to be curtailed on a month-on-month basis to the point where it is completely withdrawn by September, and that will have some impacts on not just the US economy, but other markets around the world, markets that have been the beneficiary of a significant amount of US liquidity, and I primarily refer to what we call emerging markets, which is largely Asian economies and Latin American economies. Those economies might display more volatility over the next 6 months or so as that stimulus is removed. We're seeing in the US that house sales are at their highest rate since 2008. Consumer spending is increasing, and generally other indicators are, whilst mixed, they're generally supportive of a continuation of that trend over 2014, notwithstanding the risks that will be presented from time to time by the withdrawal of that stimulus.
One of the biggest stories of the last few weeks is obviously the situation in the Ukraine, which has obviously caused tension between Russia and the West. What's the likely impact of that, do you think?
Initially, there was a very large knee-jerk reaction to markets, especially in Europe. The US market was hit a little, Australia a little, but by and large, the markets have recovered substantially since then. And I think it's generally recognised that the economic sanctions won't pose a big impact or a big threat to the world economy in 2014. The big risk that still lingers, though, is the geopolitical risk and the rise in tensions between Russia and the US to a level that we haven't seen since 1989. That's the big concern, and it's a case of, what next for Vladimir Putin and what next for Obama in terms of how they deal with the crisis and whether this standoff escalates into something that's perhaps more militarily engaged. That's the big concern, but for now, I think markets are generally calmed enough to expect that we won't see this blow out of proportion.
So going into the second quarter of 2014, how have we positioned our portfolios for our clients?
Well, the top end of the market seems to be pretty fully valued at the moment, and that's led us to increase cash weightings a little in the Australian shares portfolio and also in our international exposures. We're seeing value, strong value, in stocks outside the top 30 and top 50, but the top 30 seem to be largely fully valued at the moment. The reality is that as long as interest rates remain low, which we expect for some time, and as long as there's still large amounts of stimulus thrown at the world economy, there will be an incentive for investors to continue to chase profits in the share market. And we do expect asset prices, or more particularly share prices, to increase over the next 12 months, driven by that the liquidity that those factors generate. In terms of the better investments that we've had over the past few months, we've had some very strong performers from companies that, and getting back to the theme we discussed a few months ago, we've had very strong performers from companies that generate a significant portion of their revenues from the US in particular. Companies such as Computershare have performed extremely well in the first quarter. QBE has bounced very well, albeit off a lower base from the last quarter of last year. Amcor also derives a significant portion of its revenues from overseas. They've had a good start to the year. So it has been a good start to the year for many Australian companies. We've also seen strong performances from some of our US positions such as eBay and Facebook. Now, in recent days, a lot of tech companies in America have been hit on fears that there's a bubble emerging in technology stocks. But generally, those stocks are stocks we see as good long-term investments, and they have been good performers in the first quarter for us. That said, we are adopting a more defensive posture for the next few months, given the risks that have emerged. Obviously, we've got the Ukraine, we have concerns over China slowing, and also concerns as to whether the US will genuinely continue to recover, and whether it was just weather factors curtailing some economic figures in the first couple of months of this year. But in light of those, we're continuing to be a little bit more defensive. I mean, that does two things. Firstly, it means that we're somewhat, and having higher cash weightings means that we're somewhat insulated from the volatility and potential downside that may come. It also means that we've got some good firepower to throw at the market when opportunities do emerge, which we think they will over the next few months.
Well, thanks very much for your insights, Chris, and thanks for your time today. I hope you've all enjoyed episode 2 of the Akambo Investment Series. Until next quarter, we'll see you then. Thank you.